introduction. So first of all, thanks for doing this.
It's my pleasure.
So Matthew is a mortgage broker with
Orbis Mortgage Group.
Or Orbis Mortgage Group. And how long have you been doing that?
For 3.5 years now.
Cool. I guess I wanted to start with just a little bit about you. Like, I have a lot of students, and this is a potential career path for a lot of my students. So I wanted to know a bit about you, your background, eventually how you chose this career. But let's start with just your background.
Yeah, sure. So definitely a business background, but most mortgage brokers have kind of like a finance or banking background. So a lot will start in the banking world, work their way up, eventually become a mortgage specialist, and then they'll see the advantages of becoming a mortgage broker, and they'll leave the banking world to become a mortgage broker. But I came from a completely different background where after school, I joined our family business, and we used to design fireplaces here in Montreal.
Okay, wow.
We'd manufacture them overseas in China, import them, and then we'd sell them to different retail stores all over North America, so like Canada, the States, and Mexico. And when I joined in logistics at first, so I got to see every single aspect of the business, which was really cool. But I joined in logistics, so packing orders, booking different freight companies to ship different products to different people. So sometimes it was like, booking truckloads to send to stores. Sometimes it was just online orders that we'd send one box at a time. So like shopping around for that. And then after the logistics part, our order desk manager quit out of nowhere.
Okay.
And like for a week, it was like a disaster. So then they had me come up, try to kind of clean everything up and figure out the order desk. So that was like another aspect that I learned. And with the order desk came customer service. So I did a couple of years of customer service there. And then that kind of just tumbled into sales. So started doing road shows, like a lot of trade shows all over the States, all over Canada, selling to retailers. So meeting with like, let's say in Quebec, there's like Club Piscine or, Jardinville, all these kind of retail chains that we would sell wholesale to. And then from there, I started managing the company as a whole.
Oh, wow.
Yeah. So
this is your family business?
It was a family business,
okay.
Yeah. So my dad owned it. I ended up buying in at one point. So I was part owner. And then eventually my dad left. I had been there for 8.5 years. And the last 2 or 3 years, I wasn't really learning as much anymore. So previous to that, like I was learning every day, like learning new aspects of the business and, encountering new challenges. And then the last 2 or 3 years, I wasn't learning as much. So my interest kind of started falling. And that's when I partnered up with my dad to flip a property. So that's kind of how I started to get into real estate.
Okay.
So we flipped the first property. I was more of just like a money partner, didn't manage very much of it, but I was there the entire time. I'd go in every couple of days just to see the progress. And that ended up going really well. And then after that, I bought a triplex with my wife, my now wife.
Okay.
And that we managed from A to Z. We renovated all 3 units, found tenants, rented it out, refinanced it, bought another property. And by then, that's when I started really getting into real estate. Like I had come up with the BRRRR strategy without knowing it actually existed. And obviously after doing a bit of research, I was like, oh, obviously this exists.
Yeah.
but then that's kind of when I was like, okay, cool. You know what? Like I'm kind of looking for a career change. Let's do some research. I like real estate. Should I become a real estate broker or maybe a mortgage broker? I found out there was like 20,000 real estate brokers in Quebec, only 2,000 mortgage brokers.
Okay, yeah.
And I was like, okay, I don't want to like spend 2-3 years like building a business, not making very much money. And I figured I could do it a lot quicker as a mortgage broker rather than a real estate broker just because of less competition.
Sure.
And then when I thought about my process in applying for mortgages, I realized that I hadn't learned very much. Like I didn't know why I chose a certain mortgage product. And I figured if I become a mortgage broker, I could have more of an education point of view where I teach clients why they're choosing a certain product, why they're going with a fixed rate or a variable rate or a 2-year term versus a 5-year term. And decided to basically tell my dad and my partner, like, look, either we sell the company or we find someone else to run it. And we happened to find a buyer out of nowhere, sold the company. I stayed on for 6 months to kind of train the new owners. And in the meantime, I did my license to become a mortgage broker. And that was it.
Well, and is the license to become a mortgage broker very different from becoming a real estate broker?
So it used to be the same license.
Same, right? That's right.
Yeah, it used to be, yeah. So we used to be both mortgage brokers and real estate brokers regulated by the OSIC.
Yeah.
And now mortgage brokers are regulated by the AMF, so the Financial Markets Authority.
Right.
So it's very different now. When I did it, it was still with the OSIC, so it was very similar. But now it's very different.
Now, did you have to do, when it switched over, did you have to do some kind of equivalency, or do you have to?
No, so my license was like grandfathered in.
Okay.
Yeah. But yeah, so a lot of real estate brokers had the double license.
Right.
And they weren't active, so they had to maybe do an extra course, I think, to maintain their AMF license.
Interesting.
Yeah.
And you said your background was in finance. Did you study finance at?
No, more in business. So just like I studied. So I went to CEGEP,
Okay.
International Business at Dawson.
Okay.
And then I was planning on taking a year off before going to university.
Right.
And then that's when my dad was like, "Okay,
That's when you got into the business.
yeah, exactly." My dad was like, instead of working, I think I was managing Ben and Jerry's at the time.
Okay, cool.
So he's like, instead of doing that, like just come
Sure.
come learn at our business, and then ended up staying for 8.5, 9 years.
Wow. And here you are.
And here I am, yeah.
Okay, interesting. I wanted to talk about. I mean, we could do this kind of throughout, but there's a lot of things you said just in that background that's like hitting a few points here. But mortgages, right? So I think everyone knows mortgages. Everyone has heard of a mortgage, right?
Yeah.
Like, okay, a mortgage is to buy a house. But I think 95% of people just know it as a mortgage, as a loan when you buy a house.
Yeah.
But I feel like there's a lot that we don't know about mortgages, right? Maybe you can tell us, a few things, like top 3 or 4 things, or secrets, if you will, that people don't know about mortgages that maybe they should know.
Right.
Especially somebody who's trying to get one now. Right.
For sure. So I think, and you're so right. Like I remember when I was doing my license, like I have friends and I would talk to their parents and I would tell them like, yeah, I'm doing my license to become a mortgage broker. And they're like, what's that? I was like, you own like 5 properties. Like, how don't you know? So it's like, you're right. It's not known. And people think it's just going to your bank, getting a loan to buy the property, and that's it.
Right.
But I'd say like the biggest secret, and people default to their own banks. So, growing up as a kid and forever, I banked with BMO. So for me, before becoming a mortgage broker, like my first thought would have been like, hey, I want to buy a house. So I'm going to go see a real estate broker. And then the first thing the real estate broker says, are you pre-approved for a mortgage?
Right.
And it's like, no, okay, well, either go to your bank or go see a mortgage broker.
Right.
But if you think about getting pre-approved, I would have gone directly to BMO because they're my bank. I think, or I assume they're going to give me the best rate, the best product. But that's false. There's so many banks, so many lenders, and they're all competing for mortgage business. So just because you bank with a certain bank doesn't mean you're going to get the best product or the best rate from that one bank. Different banks offer different types of mortgage products also. So I'd say the biggest secret is it's important to shop around when you're looking for a mortgage.
Yeah.
So rather than going to that one bank, you can use a mortgage broker to kind of tell them what your objectives are, and they're going to help guide you in ensuring that you're choosing the product that responds best to your needs.
Okay. So tell us then about, actually I have it here. Choosing a mortgage broker versus going with your bank. So if I wanted a mortgage and I went to my bank and I spoke to a mortgage specialist at the bank, that mortgage specialist works for, say, RBC, so they're giving me an RBC mortgage, right? Whereas if I were to call someone like you would shop around at different banks to find me a good mortgage, right?
Right.
And so tell us more, I guess, maybe about like the different types of banks, right? Because everyone knows the big 5 or the big 6 now, but I'm sure there's other banks. I've heard of virtual banks and online banks and all that stuff. So what's the difference between the traditional bank and an online bank, and are there benefits of choosing one versus the other?
Yeah, so it's always case by case, and that's the first thing a mortgage broker will say. It depends on your situation. But big banks, so the chartered banks, are the classic RBC, BMO, CIBC that you have your day-to-day banking account with. Yeah. And then there's also credit unions. So in Quebec, we have Desjardins. Okay. In Ontario and the rest of the provinces, there's quite a few more, but in Quebec, like the big one's Desjardins. Right. And then there's the virtual lenders or non-banking financial institutions. Okay. And they include like First National Financial, Home Trust, MCAP, Equitable Bank. There's a few of them. And the big difference is all they do is mortgages. They're only specialized in mortgages. They don't sell credit cards, savings accounts, investment accounts. They don't have a branch where you could go speak to someone in person. So they reduce their cost of having, a bunch of different branches all over the province. And in doing that, oftentimes they can offer slightly lower interest rates depending on the mortgage product that you're looking for.
So then, what's the con? Like, why does everyone go with the big banks?
So I think the reason why the big banks have the majority of the market share is really because people just assume like, oh, I bank with them, I'm going to go see them. Right. It's going to be easier. But as soon as you speak to a mortgage broker, you kind of learn that there's a lot more available to you. Yeah. And then depending on the down payment amount you're putting, depending on the type of property you're buying, it might end up making more sense to go with a virtual lender. I think a lot of like the older generations are a little more hesitant because like they like being able to see and speak to someone in person.
I always thought, from what I heard, that you go with a virtual bank or an online bank if you couldn't get a mortgage with the big banks. I thought that that's what they were for.
Right. So there are like B lenders or alternative lenders, and a lot of them are non-banking financial institutions.
Okay.
And they still exist.
But it's not strictly that. Like
No.
there are, I can get, like you said, often a better mortgage all around.
Yeah.
With a virtual lender.
And I wouldn't say that it's like a better mortgage. It just so happens to be that, let's say for an insured purchase. So if you're putting less than 20% down, property under $1 million where it's owner occupied, and you're amortizing the mortgage on a 25-year period, on insured mortgages, oftentimes the non-banking financial institutions will have slightly better interest rates. And I think it's just because they're able to lower all of their other costs.
They have less overhead.
Less overhead, yeah, exactly.
That makes sense.
Yeah, and it doesn't mean that they're a better product. It just means that it might be a slightly better rate. You might save a little bit of money. And it doesn't mean that at the time of the renewal, you won't switch to one of the big banks, because when you renew your mortgage, you can switch.
Right.
But at the time of purchase, like oftentimes on an insured product,
okay, that's just like what you've seen, I guess.
Yeah.
Okay. When you renew, this question I get a lot, and maybe you can explain it better than I explain it to people. I took out a mortgage, let's say, with RBC, 30-year amortization. My term is up. Now it's time to renew. Do they have to renew me? Like, is there a scenario where I was approved 5 years ago, and now something happened, whatever, I paid my mortgage and everything, but I get to the bank, and they don't approve me for renewal? Is that in theory possible?
In theory, yes, but you would have to breach the contract. And like, as an example, not that I've ever heard of this actually happening, but like when you have a mortgage, you're responsible to maintain the property to a certain standard.
Right.
So if you neglect the property,
right,
technically they could decide to not renew your mortgage because
okay, but let's say you kept, you made all your mortgage payments, you took care of the property, but like separate from that, you missed a few credit card payments or whatever. Like they can't be like, oh, like now your credit score is so low that we cannot renew.
So you're not re-qualifying at the time of renewal.
Okay, that's kind of what I'm trying to ask.
So from your specific bank that's already offering you the mortgage, you're not re-qualifying to renew. But if you were to switch banks,
if you're trying to switch,
then you're re-qualifying. Yeah.
Okay, that makes sense.
Yeah.
Okay, cool. Speaking about the different lenders, right? So okay, again, in Canada, we have the big six. From what I understand, they're pretty robust, right?
Yeah. And
all these like secondary banks that no one really knows about. And it's really right now with everything going on, is that something to consider? With obviously SVB crashing and all these other banks in the US now, if I have a mortgage with a virtual bank, should I be worried, or is that something that hasn't really made its way across the border?
So in terms of let's say SVB and a few others having closed or shut down in the last month or two, I think it's something to consider, but I don't think that it's crossing over into Canada. So just to make a clarification, like let's say the non-banking financial institutions like First National Financial or MCAP, they're, first of all, like First Nat's like a publicly traded company. So they're a massive company, and some of their main investors are the big banks. So
interesting.
Yeah. So let's say like MCAP is a big one, and MCAP's one of their biggest investors is BMO.
Okay.
So when you look at the mortgage product, the rate and the terms and conditions, they're literally like BMO terms and conditions, BMO products, just labeled under MCAP.
Okay.
So it's, they're well backed by the big six banks. So I don't think there's any risk of the non-banking financial institutions failing. Mm-hmm. And then another one, just because a lot of them aren't that well known, like Manulife is a virtual lender or a non-banking financial institution.
I thought they just did insurance.
Yeah. So they also do mortgages. They have a mortgage division. So it's, like these are massive financial institutions. They're just not chartered banks.
Right.
Yeah.
We don't have it, or you can maybe tell us. So in the US, like essentially anyone could open a bank. Well, anyone, but there's like, there's the national banks or the Wells Fargo and Bank of America and all that. And then there's the regional banks, and then there's probably like local banks or something, right?
Yeah.
We don't have that in Canada. We just have what you said, the chartered banks,
credit unions,
and then these guys.
Yeah.
There's no that's it basically.
Yeah, that's pretty much it. So in the States, I think there's like 4,200 banks or something.
Something like that.
Yeah, and in Canada, I think there's like if we count all the credit unions, and I think there's like 80 or something, 82.
And who regulates all that?
Chartered banks are regulated on their own. Credit unions are something completely different. And then non-banking financial institutions have regulations when it comes to mortgages.
Okay.
So like OSFI will regulate the non-banking financial institutions and anyone offering mortgages. But chartered banks have their own rules they have to abide by because they are chartered banks. Credit unions is provincially regulated,
Right.
I believe,
Yeah.
if I'm not mistaken. And then the non-banking financial institutions is really by OSFI. So they're the ones who will decide like, okay, you're offering the client a 3% interest rate, but we still want you to qualify them at 5.25%.
Yeah, maybe tell us a bit about that, because I've heard that so many times from different people saying, oh, like if the rate is 3, you have to qualify for 5. Is that true across the board wherever you're going to get your mortgage?
It's true for A lenders. So we talked about alternative lenders there that we can bend the rules a little bit.
Right.
But for A lenders, the qualifying rate came in after 2008 with
Right.
what happened in the States with the massive failures from the banks, especially related to mortgages. And so the qualifying rate is, if you were going to get a mortgage at 3%, like I said, we'd have to qualify you at either 5.25% or 2% above whatever rate you're getting, the higher of the two. So a year ago, it would have been the 5.25%. Right now, we're seeing rates at around 5%. So we have to qualify people at 7%. And we do that to protect the client, but also the economic system in Canada from failing if ever rates did go up, just like they did last year, right? So anyone who got a mortgage at 2% or even 1.8%, we qualified them at 5.25. So there is like a big buffer there. Even if the rates went up significantly, at least we had qualified them at a higher interest rate.
Interesting.
Yeah, and it worked. Like we are seeing.
Well, now we're seeing a good example of why that's the case. But I feel like up until now, people found that to be kind of like, I always remember hearing that and saying like, seems crazy. Like, if I can afford it at 3, but now I get it. Now it definitely makes sense.
And like mortgage brokers are the first to complain about the qualifying rate because it's like, oh man, like this client could have qualified for the property they wanted, but we can't because of the qualifying rate.
So in that case, if somebody, if somebody doesn't qualify for the house they want at 5.25, then I guess they would qualify for less, right? That's basically
exactly.
So you tell them, okay, this is how much you can go for.
Yeah.
Maybe tell us a little bit about that process. Like, I've seen one of your Instagram videos, but you can explain it again. Pre-approved.
Yeah.
Versus what's the other one?
Pre-qualified.
Pre-qualified. So what's the difference really? So for most people will hear those two and think they're kind of the same thing, right?
Yeah. They sound super similar. So getting pre-qualified for a mortgage is basically getting a quick estimate on how much you should be able to qualify for, but without any due diligence from a bank or a mortgage specialist or a mortgage broker.
So what is that? They just ask you how much you make, punch it into their thing, spit out a ratio. And
or I have an app that I'll send clients just to help budget. So for them to shop around, they'll be able to budget all the expenses related to the purchase of a property, but there's a function where they can put in their income, any debt that they have, the down payment amount they want to put, and their estimated credit score, and that'll tell them like, you'll be able to qualify for a purchase price of this amount, and your interest rate you'll expect an interest rate at about this amount.
Okay.
That's a pre-qualification.
Right.
But then a pre-approval is submitting all the supporting documents, which include their, letter of employment, pay stubs, proof of down payment. So then I'm literally underwriting the file and saying like, yes, if you have an accepted offer at this price with this down payment, you will be approved for a mortgage with these banks. So
pre-qualification is just like you have the list of whatever, all of my details, but then to pre-approve me, you need to go and confirm all of those points. And if they are all valid, you could approve me for X amount.
Yeah, exactly. So I'll do the job of the bank or the lender's underwriter and make sure that I'm answering all the questions they might have so that we can eventually get an approval if they get an accepted offer.
Interesting.
Yeah.
Okay. Cool.
Yeah, so that's really that is step 1 for anyone looking to buy or invest in real estate. It's confirming how much you can qualify for. And then once that's done, they can establish their own personal budget also, because just because you can qualify for a certain amount doesn't mean you want to go to the max you can qualify for. So it's important to kind of understand all the other costs associated to a purchase, and then you could comfortably start shopping around knowing that my mortgage payment will be this much, but I'll also consider insurance payments, municipal and school taxes, and any other maintenance costs related to a specific property.
And is the process different if you're buying a home or something to live in versus buying an investment property?
Yeah, there's different criteria in qualifying you. So if it's a rental property, you have to put a minimum of 20% down. Right. If you're not planning on living in it, it's minimum 20%. We can amortize on a 30-year period instead of 25. And we're also going to consider rental income. So, if you're buying a single family home, you might qualify for this amount, but if you're buying a rental property, it might end up being more because we're going to consider the rental income that it's generating.
Is that the case if it's more than 5 doors? Or any, like if I buy a duplex?
Okay, that's a great question. Yeah, so I'm referring to residential properties. So there are lenders that will finance up to 6, even 8 doors as a residential mortgage, where we consider your personal income to qualify you for the file.
Right.
And then as soon as you go for a commercial mortgage, so really anything 5 doors and up, we're going to consider the building's revenue to see if it can sustain itself financially. And your personal income isn't taken into account necessarily.
Okay, interesting. So, so maybe, and do you handle those as well, or?
So I'm specialized in residential financing.
Can you speak a bit on commercial?
A little bit, yeah.
So, let's say I'm interested in buying a 5-plex, and I apply for a commercial mortgage. How much would you say is the building versus the borrower? Like when you're gonna, when they're going to consider the file, is it completely the building and the borrower doesn't really matter, or is it a bit of both?
It's a bit of both. It's definitely a bit of both. So they'll determine like the economic value of the building, like what are its rents, what are its expenses. It's so income versus expense basically.
Right.
And that's how they'll determine how much they're willing to lend for a specific property.
And does that have to be like potential income, or the building is current
income? Yeah.
Okay,
so you might have to buy it with a 50% down payment, and you only get a 50% loan to value ratio. But once you optimize it, so once you renovate everything, increase all the rents, they might be willing to lend you up to 80% or even up to 95% depending on the property. But the person still matters. Like they'll want to ensure that you have some experience in managing real estate. If you have a track record, it definitely helps. If it's your first time, maybe on a triplex or fourplex, they'll be more lenient. But if you're
trying to buy a massive building, you probably won't.
They might make it that yes, they'll finance it, but you have to use a specific management company.
Oh, interesting.
Yeah.
Okay, that's cool.
Yeah.
But you said up until 6 or even 8 doors, you could potentially do that as a residential mortgage, where I feel like that would, okay, that's interesting.
Yeah.
Where they would just look at you basically, like can you?
They'll look at you and the rental income, but it's really about your personal income, your debt service ratios.
Yeah. Interesting.
Yeah.
Maybe tell us a bit about that, actually, the debt, the TDS and GDS.
Yeah. So basically there's 2 debt service ratios that we look at, the GDS and TDS.
Yeah.
And the GDS is we look at your gross revenue versus the expenses created by the purchase of the property.
Gross before tax?
Yeah.
Okay.
Yeah, gross before tax. And we'll look at basically the mortgage payments based on the qualifying rate. So the 3 plus 2%, or sorry, the 3, let's say the 5.25 or the 4.4 plus 2%.
Yeah.
We'll look at the municipal and school taxes, heating costs, and condo fees if there's condo fees. And we don't want those expenses to surpass 39% of your gross income.
GDS 39? Yeah. I feel like it used to be lower. Did it used to be 32?
So CMHC, which is one of the insurers, the government regulated one, during the pandemic lowered the debt service ratio limits.
Okay.
It was still doable at 39% through the 2 other insurers.
Okay. But
CMHC, they regulated
the main one.
Yeah. They had lowered them. Yeah.
Okay. So that's basically the direct cost of the home, right? So you said the mortgage, the taxes, the heating, and then the condo fees.
Correct.
Can't take up more than 39% of your gross income.
Yeah.
And then there's the TDS, which I think includes all your other debt.
Exactly. So if you have like a car payment, student loan, bank loan, we take into consideration all those monthly expenses, add them to the GDS ratio, and we don't want the total to surpass 44%.
44.
Yeah. So 39 and 44. And then we also look at someone's credit worthiness. So their credit bureau, basically. We look at, have they paid their credit cards or their student loans or their bank loans on time in the last whatever amount of years.
Right.
Obviously, someone who has many late payments in the last 2-3 years, like they probably won't get approved for a mortgage.
Right.
It's really important for the banks to have someone demonstrate credit worthiness before buying real estate.
Yeah, that makes sense.
Yeah.
And what's your opinion on those percentages? Like, I feel like, or is it, do most people really try and push up against that limit? And do you think that those limits are too high, or?
I think the limits are at the right percentages.
Because 44% gross, right? Like, I don't know, I make, let's say somebody makes 150K. So what is that after tax? 100, maybe a bit less.
So less, yeah.
But it's 44% of the 150.
Right.
So effectively, half of their take-home pay can go to their home.
Yeah. To their home and their other expenses at the
Right.
44.
I guess the TDS. Everything else.
But like it really depends on the person, right? And I can only speak to the clients that I've had the privilege of working with. And there are many different types of clients. I'd say probably half of my clients are like getting close to their limit. But it really depends on their own personal budgets, like as long as they're aware of all the costs associated to the purchase, and we, go through that with them to make sure that they are aware and it fits in their budget.
Then it fits.
Yeah. But it's up to the person, right? Like some people just don't want to get anywhere near it because they have a much smaller expense budget, or that, a smaller amount that they allocate to their housing.
Right.
So it really depends on the person. But I think it's a good amount, any less, like, I think it'd be like, especially now, it'd be so hard.
How much you make too, right?
Yeah.
If you make $100 million a year, you're probably not coming anywhere near that percentage.
Yeah.
But if you're making only 150 or 200, then I imagine that. Yeah.
And like realistically, just like in the housing market we're in, like if it was any less than that, like it'd be tough for people to qualify for purchases.
Are you seeing? I think you posted something recently about it. You spoke a bit about Montreal and the housing market and how we had 2 consecutive months of growth. Maybe you can speak about that.
So the average home price actually increased over the last 2 months.
And that's in Montreal?
In Montreal specifically, yeah. So that wasn't the case in like Quebec City, but I think it was also the case in Toronto and Vancouver.
When you say Montreal, though, do you include like the greater Montreal or just the island of Montreal?
Greater Montreal.
So like Laval, North Shore, South Shore.
Yeah.
Interesting.
Yeah. And that was for the first time in a long time, right? That we finally saw prices trend a little bit upwards. And that was a report by Sagen, which is one of the other insurers, one of the 3 insurers we have in Canada.
And that's, you think, because of interest rates stabilizing?
Yeah, I think it has to do with interest rates stabilizing, probably more so, honestly, like TIF from the Bank of Canada kind of signaling a pause in interest rate hikes. I think once...
Did they hike recently? Or no, they did?
In the States.
They did.
In the States,
and we typically are, we lag behind.
We'll have a lag, yeah. I think the Bank of Canada is willing to allow like up to 1% difference between the Fed and the Bank of Canada.
Okay.
Yeah, but I think the signaling of the Bank of Canada pausing on rate hikes is what really got the market going again.
Yeah.
Yeah.
So, a question from a student, I guess you kind of answered it, but a student asked if you think rates will keep rising. So you kind of answered that the Bank of Canada said no, right?
For now.
Well, I'm sure they say it in a way where if we need to, we will.
Yeah.
Right?
Yeah.
But the signal right now is that it won't?
For now, they're pausing and they're basing their future decisions on the new economic data coming out.
Sure.
And it's, for them, the language they use is really important because they don't want to make it seem like they're completely done and it's out of the question that they raise again. So they really want to leave the door open to more interest rate hikes. So it's definitely plausible, like if inflation sticks and it's just not coming down to where they want, which is like a 2% target.
We're way above that right now, right?
So we're down to 4.2% at the last announcement. And it seems like it's coming down to 1% a month almost. So it's like a big difference.
Really?
Yeah. So I think once we get closer to 3%, that's where it's going to slow, and we're not going to hit 2% this year.
Now, is inflation a good thing or a bad thing for real estate, right? Because real estate is an asset, and so I imagine that inflation increases its nominal value.
Right.
Is that the case though, or is that it's a bit of both, I guess, because people are not buying because of interest rates. So do you think that obviously home prices have gone up like crazy in the last few years, and that contributed to inflation.
Right.
But generally speaking, do real estate values follow inflation? Like, will the average home increase by 2% a year?
I think on average, sure, by at least that. But I think it's very dependent on the economic climate in the time that we're in. Like right now, you'd think that with the rates having gone up so much, you'd think that the correction would have been a lot bigger. But what happens is a lot of people just want to hold on to their property because they don't want to sell because they wouldn't be able to afford something else.
Sure.
With the rates having gone up so much. So that contributes to lower supply, which helps maintain the prices, which I think contributed to the correction not being as severe as a lot of people thought it would have been.
Right.
So it really just depends. Like I think we're in a massive housing crisis in Canada. And like that's
shortage,
clear.
you mean?
Yeah, shortage. Yeah, so massive shortage on supply. Canada needs massive immigration numbers every year.
So that's why there's a shortage, you're saying, because we have so much immigration that.
I think it's, more so just because we're not, the rules and regulations in place by local municipalities and governments make it that it's hard for developers to build in Canada. It doesn't make it easy for them to build, tons of units for.
It feels like tons of units were just built downtown.
I know.
But outside of that, you're saying despite all that, because I see buildings going up, but despite that, we still have a shortage.
Yeah, like I don't have the precise numbers,
Sure.
but if I'm not mistaken, I think it's around like 200,000 units were being built a year, which is a lot. But
Sounds like a lot.
Sounds like a lot. But last year, 2022, Canada had 1 million new people living in the country.
Oh wow,
close to that, yeah. So including like students and everyone who moved to Canada in 2022. So it's a massive number, and now our target I think is around 500,000. On a national scale.
They're trying to reduce that?
No.
Oh, we're trying 500,000 homes.
No, 500,000 new immigrants.
Okay.
Yeah, and that's like we're gonna hit the 500,000 mark for sure, and they don't want to lower that. And we need immigrants in our country.
I'm sure, yeah.
So if they're not building enough housing, and I forget which economist I heard talk about this. I think it might have been Benjamin Tal from CIBC, saying how it would be really good to have, let's say a tax break for developers to build rental specific units. So right now developers build to sell, but that doesn't necessarily help the rental market.
I feel like there's been a shift though, right? Like I used to never see rental developments. I feel like I never saw them. And in the last few years, I feel like I've seen a lot more coming up. Is that because it makes more sense as a model for the developer? Like, I could rent out this whole building and then sell it as to a fund or something? Is that usually the?
I feel like that would make sense for sure. But it really just depends on the area and what they're allowed to build, and then I guess they make their decision on their numbers.
Do you work with developers at all, or is it really just with?
No, really honestly, it's more like the consumer that I work with, or investors, like people buying residential 1 to 4 units, either investing or to live in.
Interesting.
Yeah.
And you can only give mortgages for properties in Quebec?
I'm licensed in Ontario as well.
Okay.
And then our firm has sister agencies all over Canada, but personally I'm licensed in Ontario and Quebec.
What about, somebody from Montreal wants to buy a vacation home in the US? Can you do that?
No. But I'll happy to refer them to someone who can in the States.
Okay. No, because I think it's RBC or TD. They operate down there. So
right. Yeah.
I think they are able to, speaking to somebody who's getting a mortgage in the US from TD.
Right. Or even like Desjardins has like a branch in Florida kind of thing.
Yeah, exactly. Florida. I guess that makes sense. There's so many Quebecers that go there. Interesting. Okay. So a little bit more about, I have a lot of students. They're all between 18 and 24, right? So a lot of them are going to be buying their first properties or have just bought their first properties. So I wanted to talk a little bit about, besides rates, so obviously everyone talks about rates and rates and rates, what else should we look for in a mortgage? What are the other characteristics of a mortgage other than the interest rate that you think are very important for people to consider? I think you mentioned once, and you could talk to us about this, a mortgage that is transferable? No. Portable.
Yeah.
That's where if I sell my home, I don't need to cancel my mortgage and pay the penalty. I can just port the mortgage into a new home.
Yeah.
So that's an example, right? Maybe you speak about that in a second. But yeah, tell us what else we should look for besides rates.
Yeah. So, the whole point of like shopping around for a mortgage and ensuring that you're choosing the right product that suits your objectives is really reducing the cost of borrowing as much as possible.
Right.
So I think the biggest cost that's associated to a mortgage isn't necessarily the rate, it's more so the potential prepayment penalty. So you were alluding to that by porting your mortgage, you avoid breaking it. So when you break, so there's a term to a mortgage, say a 5-year term.
Yeah.
5-year fixed term, at the end of the term, you can renew the mortgage. You're allowed to switch banks at that point. You're allowed to restructure the mortgage from A to Z. If you have, 50 grand lying around, you can put that towards the mortgage without paying a penalty. But if after 2 years, you need to sell the property, and you don't necessarily plan on buying another one, there's a prepayment penalty that comes into play. So because you told the bank you were going to do a 5-year term, but you're cutting it short, you have to pay the difference in interest rate that you would have paid or that they could get for a mortgage at the time that you break the mortgage. So the prepayment penalty on a fixed rate can sometimes be $15,000, $20,000, $30,000, $40,000.
So that depends on your balance?
It depends on the interest rate when you got the mortgage and the interest rates available, the day you're breaking the mortgage.
And the bigger the difference, the bigger the penalty?
Yeah, exactly.
So somebody who got a mortgage like at the height of COVID and got 2% and then tries to sell now, their penalty would be pretty significant.
So it's the opposite actually. In an environment where rates are going up, the bank is actually kind of happy to break a 2% rate mortgage because they can now use those funds and sell a mortgage at 5%.
So it's worse when rates have been coming down.
Yeah, exactly.
So now would be a not so bad time to get out of a mortgage.
Yeah, if you needed to.
And what would the penalty look like? Is there like a formula for the penalty?
It's called the interest rate differential, and it's slightly different for every bank. But generally speaking, like I said, it's based on the rates available the day you break the mortgage, the rate that you had when you got the mortgage, or the bank's posted rate.
Okay.
And they'll calculate the difference.
And is it, okay, so just as an example, let's say you took out a mortgage, it was 2%, today rates are, I don't know, 5%, just keep it easy, the differential is 3, but 3 kind of in your favor.
Right.
Is it then...
So in that situation, because the rates had gone up, they're going to use 3%, 3 months worth of interest as the penalty. So it's either 3 months worth of interest.
At 3% or at 5%, or the difference?
On your interest rate.
Okay, gotcha.
Or the interest rate differential, whichever one is higher. So
but if they're in for it, but this would be a negative differential.
Exactly.
So,
So that's why they'll use the 3 months worth of interest. And this is for a fixed rate mortgage.
And variable?
And for variable, it's always 3 months worth of interest.
Always.
Yeah. So the disadvantage of a fixed rate is the potential prepayment penalty.
Except in the current environment, it's pretty much the same.
Right. If you got your mortgage a couple of years ago.
Interesting.
Yeah.
Yeah. I mean, I don't think there are too many people that have rates. I guess people who just took their mortgage out.
Right.
And the rates are starting to come down. Interesting.
Yeah. So and when rates remain stable, like the penalty can still be pretty significant because banks, the big banks, have a posted rate. So even if your rate's at 5%, they'll calculate the penalty based on their posted rate, and a posted rate might be at 6 or 6.5%. So there's still like a gap in the calculation that they're using.
Right.
So with the fixed rate, main disadvantage is prepayment penalty. With the variable rate, the main advantage is the flexibility you get in being able to break the mortgage at any point, knowing the penalty is always 3 months worth of interest, no matter what.
And the disadvantage being what's going on right now?
Yeah, exactly. The risk associated to the volatility in the rate. But historically speaking, like if you would have chosen a variable rate over a 5-year period, you would have saved money by choosing variable. So if you chose variable at any point in time,
2 years, 1 year out of the equation.
Exactly. Yeah. So if you chose variable at any point since variable rates have existed, like you would have saved money by choosing variable as opposed to fixed.
Yeah.
Except for the last year.
Right. So, okay, a variable mortgage, right? So a variable mortgage, I take it for 5 years and it goes as the interest rates go. So if the Bank of Canada increases the rates by 0.25, does my mortgage go up by 0.25? Is it just like...
Yeah, exactly. So exactly. So the Bank of Canada, the rate we're referring to is the overnight rate.
Right.
And when they change it by 0.25%, all the banks change their prime rate.
By 0.25.
By 0.25, and variable rates are based on the bank's prime rate.
So prime plus X.
Prime plus X or prime minus, exactly.
Okay, great. And from what I understand also, there is a certain point. So variable rates will, your payment itself doesn't change, right? When rates go up, unless you hit some ceiling.
So it depends on the bank.
Okay.
There's 2 types of variable rates. There's adjustable and variable.
Okay.
So a real...
Variable, and adjustable variable?
Exactly,
okay,
yeah.
Guys.
But the banks kind of mix them up. And
right.
So a real variable rate mortgage is one where your monthly payment stays the same. So if the rate changes, your monthly payment stays the same. Let's say the rate goes up.
Yeah.
Your monthly payment stays the same. You'll pay more interest.
Less principal.
Less principal. But then an adjustable rate mortgage is one where when the rate changes, your monthly payment goes up. So that way you continue paying the same amount of principal, more interest.
And
it's true for the opposite as well. If the rates go down, your monthly payment goes down. And for a real variable, your monthly payment stays the same.
But you're paying more principal.
Exactly.
So for the real variable one, or the variable one where your payment stays constant, if the rates go up so much that you're only paying interest, I'm sure that's happening to some people right now.
Like over 20% of people with variable rates.
Is there a situation in those mortgages where the rates go up beyond that point?
Yeah.
And then are you accumulating interest, or is your payment at that point going up?
So your financial institution is supposed to reach out to you to advise you that, hey, you're no longer covering your interest on your mortgage, and you have the choice to increase your mortgage payment to cover at least the interest or more if you wanted to.
Okay.
So,
but you don't have to?
Depends on the bank, yeah. So I think in this situation, banks aren't enforcing it.
Right.
So they're allowing you to accrue more interest. They are advising you to increase your monthly payment at least to cover the interest portion. Right. And then at the time of renewal, that's when you have to restructure. Like it's either your monthly payments go up significantly so that you can stay on the same amortization period. So if you had 20 years left and you want to stay on the 20-year period, your monthly payments will go up significantly.
For sure.
Because you haven't been paying your mortgage down.
Right. Take your...
Yeah. Or, like the solution in a lot of cases, if you don't want to increase your monthly payments significantly, is to change your amortization period. So to bring it back up to 25 years.
And is that a new qualification at that point?
It'll depend. If you're doing it with the same lender, oftentimes they won't requalify you. They'll simply like offer you to increase your amortization. Okay. But if you were to change banks, you'll requalify. And
any other time.
Yeah, exactly.
Do you think that you said 20% of people, or close to 20%,
have hit their trigger rate? Yeah,
that's the word I was looking for. Trigger rate, right?
Yeah.
So, everyone talks about how if you want to buy real estate, it's going to be in the next year or two, because a lot of those people who had rates, let's say you took a rate out in the middle of COVID, and it was 2%, your renewal is going to be coming up in the next couple of years, right? Yeah. What is the general prediction, or what do people really think? Is there going to be some crazy meltdown that people are just going to have to sell their homes because they can't renew? Because, technically, if they stay with the same bank, then they don't need to requalify.
Right.
But they might not be able to afford the new mortgage.
Correct.
Right?
Yeah.
So is that what people are kind of expecting?
So, like right now, delinquencies are at like almost an all-time low.
Really?
Yeah. But like you said, in the next 2 or 3 years, people will be renewing. So the people who got the 2% rate will be renewing. And if in 2 years rates are still at around 4.5% to 5%, like that jump in monthly payments is going to be really significant.
Especially that they're not paying down any principal, especially people that were on a variable and are essentially not paying anything down right now. That's
exactly. Yeah.
Jump.
I think like something else to note for variable rate mortgage holders is that the majority of people on variable rates, the people with the higher risk tolerance, generally speaking, have like a higher income,
right?
Household income. So a lot of them can afford the change.
Yeah. I got it. Yeah.
So if you're more risk adverse, you might have, most people would have gone towards the fixed rate. But at the time of renewal, so in a year or 2 or 3, they will be renewing at a higher rate. We think so far.
Yeah.
Unless the rates do come down quicker than we think, but it's likely that they'll renew at a higher rate. But then the solution, like I mentioned earlier, is to maybe restructure the mortgage. Yeah.
Right. Okay.
Yeah. So there are solutions, but I think it is clear, like we will see delinquencies go up. I don't think it'll be a massive crash.
Right.
But we will see the delinquency rates go up. I think it was RBC came out with an article yesterday stating that their delinquency rate on mortgages have not been affected yet, but they are seeing late payments on credit cards, car loans, that kind of thing, right? So like
it's only a matter of time.
It's only a matter of time, but it's just how significant is it going to be? Is it going to be a massive, crash? But I don't see it.
Okay. Yeah, I think just people in general might be worried about that. They took out, mortgages. Like I know just in my neighborhood, like homes were selling, for almost double.
Yeah.
Practically 1 year to the next. Because I think rates were so low, you know. So I think some people must be worried about that.
Yeah.
But it's good to know that you could restructure and extend your amortization period. You can't go to 30 years, right? 30 years is strictly.
So you can go to 30 when you're refinancing or restructuring. And there's even like for the big banks had been given permission by the federal government to actually go up to 40 years for people who really couldn't afford to even restructure at 30 at this point. Yeah. So people on variable rates were allowed to restructure immediately on a 40-year period in emergency situations, but it was done.
I never heard that.
Yeah. They kept it kind of like on the down low.
Yeah, otherwise I guess people would have been rushing to do it.
And it's really emergency situations, right? Somewhere where it was clear, like, they need the 40-year amortization to...
They would rather you renew at 40 years than default on it.
Yeah.
That makes sense.
Yeah, banks aren't in the business of repossessing homes. That's not what they want to do.
It's such a hassle.
Yeah. And the delinquencies that we will see will be, with private lenders, with alternative lenders, not so much with banks. Like, I'm sure the bank rate will probably go up a little bit. Mm-hmm. But it's more so the people who were already using an alternative or a B lender or a private lender because they didn't necessarily qualify with one of the A banks or one of the big banks.
Okay. And private lender, they obviously give rates at much higher, give mortgages at much higher rates, right?
Yeah, exactly.
You don't work, do you?
I work with private lenders. The majority of the clients that will end up going with a private lender are usually investors who are maxed out with all of the banks, and they're working on flip projects or where they'll renovate and then optimize a property. And to get it done, they need to use a private lender for 6 months to a year.
And is that like they take a second mortgage on the property, or the?
It can be a private mortgage, can be a second rank mortgage, or maybe a property that has a foundation that's completely shot.
Yeah.
And no bank wants to finance that because the collateral itself is in jeopardy by the foundation being shot. So the private lender will finance until you repair the foundation, and then we could transfer the mortgage to like an A lender. So they're kind of like a temporary
the A lender
solution.
doesn't want to do it. It's like a bridge.
Yeah, exactly.
Interesting.
Yeah.
And so maybe tell us a bit about that process. So somebody who wants to, do exactly what you said, they need, a second mortgage because they want to renovate their apartment building. The con that I heard, and you can maybe clarify, is that they take some upfront fees. I think they call it, there's a word for it.
Like a lender fee.
Yeah, like 1 or 2% of the thing upfront. Is that often the case with private lenders?
Yeah, I think there's always a fee built in, and it's just how they present it to you. So it might be like, just as an example, like a 10% interest rate for a year with a private lender, and then they might have a 2% fee on top of that. Or there'll be another lender that's just offering like a 12% rate for the year. So it's kind of like there's always going to be a fee built into it. Mm-hmm. But generally speaking, private lenders do have upfront fees.
Okay, yeah.
Yeah. But when they calculate, like, as a mortgage broker, we need to have an exit strategy. So we wouldn't have a client use a private lender if they were going to have to renew with the private lender forever. Because generally speaking, private lender mortgages are always interest-only payments, because at 10%, like, those payments would be massive.
That was my next question, yeah. So they cannot partially pay back. They have to pay back.
If they wanted to, they could. But generally speaking, the clients will usually choose interest-only payments just to keep their cash flow up, because it's usually for a big renovation project.
Right. And then when they get their main mortgage, they'll pay that one off.
Yeah, exactly.
Okay.
Yeah.
Okay. Interesting.
Yeah. So private mortgages are often like a solution for someone working on certain type of, project, renovation project or flip project or restoration project. It's not so much someone who's like about to lose their home, and it can be a private lender solution, but we need an exit strategy. We don't want them to be stuck with the private lender forever.
Right. That makes sense.
Yeah.
If you were to give advice to young people, somebody in university, 20, 21, 22, who's looking to potentially get into real estate, either for themselves or as an investment, they're looking to buy their first property, what advice would you give?
So I think is gain as much information as possible. Even if you're not ready to buy right now, I think it's worth speaking to a mortgage broker. It could be a year out, even 2 years out, just to understand the process, to understand what goes into qualifying for a mortgage. Mm-hmm. And that way you can set yourself up properly. A lot of times young home buyers will come to me looking to buy, but they also just took on a car lease for like, $400 or $500-$600 a month. And that has a massive impact on your borrowing capacity when you're looking to buy real estate.
Because of those ratios.
Yeah, because of those ratios, exactly. So I think it's good to speak to a mortgage broker well ahead of time to properly understand how you should set yourself up and how you should set your finances up when you're getting close to applying for a mortgage.
Yeah. So somebody I think I've heard this a million times, but you'll confirm it. If you needed a car and a mortgage, you would suggest getting the mortgage first.
Yeah, absolutely.
Car second.
Yeah, wait till you close. Wait till the money's in the bank for the mortgage before getting the car loan. Yeah, because there's horror stories. Okay, mortgage is approved, closing on the property in a month, and then 2 weeks later the client goes to get a car loan, and then the bank says, "Whoa, there's a new car loan on the credit bureau. Like, we're pulling out," and then it's like,
yeah, that changes a lot. Yeah. Wow. We spoke about this already. That's interesting. So what if somebody already owns? So I know that you can, if you were buying a property, right, and to get approved, but you already have, let's say, a car loan. You can pay off the car with I've heard banks of lending you enough to pay off the car, so you only have one payment. Yeah. If there's enough equity in the home or something like that.
So using the equity in your home to consolidate other debts. So if you have, let's say, the car payment, or you have a line of credit that's not a home equity line of credit, and you have a balance on it, if you have a lot of credit card debt and you wanted to consolidate that into one payment and you wanted to lower the payment as much as possible, the mortgage is a great tool to do that, because you can amortize it over, say, 20, 25, 30 years.
At a much lower rate than
at a much lower rate.
Credit card.
Yeah, and then you'll have that one monthly payment. You'll clear all the debt, And it's a tool that a lot of people don't realize they can use. And you
Yeah.
do that by refinancing your property. So let's say you've owned the home for 10 years.
Okay.
Let's say it was worth 600,000 and your mortgage is down to 400,000. You can borrow up to 80%
Of the difference.
of the value of the current value of the home.
80% of the current value less what you owe on it, or
Yeah.
okay, so let's say I bought it for 6, I owe 4, now it's worth $1 million, so I've got like 600K of equity.
Yeah.
I can borrow 80% of that number
80% of the value, so up to 800,000.
minus
total.
the 400
Yeah.
I owe, so 400.
600,000, yeah.
So then
Or 400,000.
and then they would you can take this money out and go like kind of like what you did, right? Buy a second property,
Yeah.
do whatever you want.
Yeah,
essentially.
exactly.
And that's interesting. The home equity line of credit that you mentioned.
Yeah.
Right. Do you recommend that as a product to anyone really?
I think it's good to have, because as you pay down your mortgage with a home equity line of credit, you can still borrow up to 80% of the value of your home. So let's say, you've paid down 100,000 of the mortgage on $1 million home, and your mortgage is down 700,000. You'll still have that 100,000 available as a home equity line of credit.
Repeat that. So you bought a home for $1 million,
Yeah.
and you
originally put 200,000 as a down payment.
so you borrowed 800.
Yeah.
And now it's down to 7.
Yeah.
So you've paid off 100K. That 100K is available.
It's available to you as a line of credit, but because it's a home equity line of credit where the property is the collateral, they'll offer you a better rate on a home equity line of credit than they would a regular line of credit.
And as you're paying it down, your credit limit on the line of credit is going up.
Yeah, exactly.
And is that going up monthly or is annually?
Monthly as you pay it down. So if you put $5,000 towards it 1 month, that $5,000 is available immediately.
So that's interesting for somebody who does plan on maybe refinancing. If they set that up initially, they don't really have to go through the process of refinancing because they've essentially in advance refinanced.
Yeah, exactly. And then, so let's say you had a 200,000 available on a home equity line of credit, and you wanted to buy another property as a rental. Like, you can take that 200,000 immediately, use that as the down payment, and once you own the other property, or as soon as you pull out the 200,000, you can go to the bank and say, hey, I have a $200,000 balance on my line of credit. I'd like to transform that into a mortgage today. So they're going to offer you whatever rates are available that day, and you can now turn it into a mortgage. And the reason why you would do that is because a mortgage interest rate is going to be lower than the home equity line of credit.
Interesting.
Yeah.
I didn't know that. So you'd have a second mortgage.
Yeah, on the same property.
Yeah. With the same lender, so
Yeah.
It's all good.
Yeah.
Right, because I've heard that technically, like the big lenders don't like you to take a second
Yeah.
mortgage on the property, but
Yeah.
if it's with them, it's all good.
Yeah.
You can still do it though. I've heard of.
Yeah.
You're technically not supposed to.
Yeah. And it'll depend, because let's say you buy a property for $1 million, just staying on that number, the lender, oftentimes the big banks will now register the lien on the property at like $1,250,000.
And that's to prevent you from taking a second.
Yeah,
mortgage.
it's so that a second rank lender basically has no room for recourse if ever they wanted to repossess the property, because the first rank, which
Yeah.
is the bank, has up to 1.25.
I feel like that's something people really don't know, and they get surprised by it sometimes. So maybe you can explain to us a little bit about what that means. So I'm going to buy a home for $1 million, and I'm going to put down 20%. So I'll borrow 800, but the bank can put a lien up to 1.2.
Yeah.
Right. What does that mean?
So it means that basically it does a couple of things. So the first thing, like you said, is it'll protect the bank itself from having a second rank lender put a lien on the property,
Right.
because now there's no more equity.
Unless the home has increased in value like crazy.
Significantly, yeah. And then on that same note of the value increasing is, what if the home is now worth 1.25 million?
Right.
If I wanted to refinance the property, I could do that without going back to a notary to increase the lien amount, because it's already at a higher amount.
Oh.
So you kind of skip a step in the refinancing process, because you don't have to go back to a notary. You can just go to the bank and they'll give you the funds right away, because their lien is already registered at the 1.25. So it has an advantage for the client as well.
That makes sense.
Yeah.
But if a client really wanted, they can get that lowered.
Yeah.
Interesting.
Yeah.
Notary, I guess, would do that.
The notary, yeah, they would do it through the bank, because the bank has to agree, but they are allowed, yeah.
Interesting.
Yeah.
Yeah, you see, these are the things that I feel people don't know.
Yeah.
And the people that do know is because they found out, on the spot.
Yeah.
Yeah.
So, and even for me, like, right, when we bought our first triplex, like, even the second, like, we bought a house, turned it into a duplex, like, I didn't really know what product I had signed up for. I didn't completely understand, just because the mortgage specialist, and I'd worked with a mortgage broker the first time, mortgage specialist the second time, and like, I had a lot of questions with them. I spent an hour with each of them at least, and they just didn't give me all of the information that was pertinent to what we were doing. Like, we were clearly buying to renovate, to rent
Right.
out, to refinance, and they didn't recommend the products that were best suited for that strategy.
The specialist.
Yeah.
Yeah. Okay. I understand.
Yeah.
Going back to the portability thing, 'cause
Yeah.
that's, I feel, very interesting. And I was speaking to my wife about this and saying, hey, like after I saw your Instagram post, and saying, hey, did you know like there's this thing that no one talks about, because everyone talks about, oh, I have to sell and pay off this penalty now. So okay, explain to us how that works. I'm buying a home for $1 million, put 20% down, $800K. I've paid it down to $700.
Yeah.
I want to sell because I want to move, downtown. I want to stay with the same lender. How does porting the mortgage work? Do they take the balance and you can use that balance to buy the new home?
Yeah, exactly. So let's say you were buying at $1 million again. You could transfer the $700,000 balance to the next purchase.
Okay.
And say you wanted to add $100,000 to the mortgage, you're allowed to do that too with the same lender. So the $700,000 will stay at the same rate. You avoid breaking it. If you have 3 years left on the term, that remains the same as well.
Mm-hmm.
And if you needed an additional $100,000, you would have the $100,000 usually at the same term. So they would take a 3-year term so that it matches the renewal date.
So when you renew the whole thing.
But if your $700,000 was at 2.5%, your $100,000 is going to be at today's rate. So it might be, at 5%.
Interesting.
Yeah.
So is that a default in mortgages? Like
No.
No, right?
Yeah,
okay,
no, good question. Because there are discount products where, there are discount mortgage brokerages that sell discounted rates because people, assume they always want the lowest rate. But you have to be careful because there are restrictive conditions associated to some of those really low interest rate products.
Right.
And they can include not being allowed to port the mortgage to the next purchase.
Okay, but what about if you're getting it from a big bank?
Yeah.
Like a Scotiabank,
Yeah.
or a TD, whatever. Are those by default portable?
I don't think they're all by default. Generally speaking, most of the general products are, yes, but I'm sure there are discounted products that are more restrictive.
And how come no one talks about this? Like, we've purchased and nobody told us, oh, it's portable.
Yeah.
Like, I've never heard that word.
Yeah. I mean, I talk about it with my clients, right?
Yeah, fair enough.
Because what I'll talk about is like the prepayment penalty and what are reasons for why someone would break a mortgage, and then how can you avoid the prepayment penalty? Because really, that's the biggest thing we need to try to avoid. Because the truth is, in Canada, the average mortgage length is 38 months. So although the most common term is 5 years, the average length of a mortgage lasts 38 months. So most, a lot of people do break mortgages.
Yeah.
And then they are caught with that massive penalty.
Wow.
Yeah. So by porting it, you avoid it. But at the same time, let's say in 3 years from now, rates are down to 3% and you have a 5% interest rate. Like you may not want to port the mortgage.
That.
Not necessarily.
It might be beneficial to.
Yeah. We'll do a cost benefit analysis to see how much is the penalty, how much you're going to save by signing on to a 2% rate.
Yeah. Interesting.
Yeah.
But it's good to have the option.
Yeah, for sure.
Are there other things like that? Isn't mortgage? You can maybe I think it's a myth, but I've heard it from various people. Transferable. Like let's say I'm selling my home to you, and can I transfer my mortgage to the buyer?
Yeah, for sure. So you have an amazing rate right now. So you had a rate at 2%.
Okay.
Not all mortgages are transferable, but you can transfer the mortgage to the buyers. They'd have to qualify for the balance if they need a balance, like a higher mortgage amount with that same lender.
Oh, I'd be transferring my balance.
Yeah.
But let's say my home, I bought it for $800K. Now my home is worth $1 million. But I only owe $650 on it.
Right.
I can transfer the $650 to them, but they would have to then put up the difference, from the lender, I guess.
Yeah, they can qualify for an additional mortgage amount with that same bank or lender, or they could put a cash.
Right.
Yeah. And it's not the case with every mortgage, but it is.
Is that common in the big banks?
Yeah, it is common. But
see, this is another thing.
But it doesn't happen very often. It's pretty rare.
Why? I feel like that's something, especially now.
Right now, it could be very advantageous. Yeah, with rates having gone up so much, definitely a very advantageous.
I guess banks don't really advertise that.
Right.
Because why would we want to? We'd rather cancel your low rate and take on a new one altogether.
Right.
Still, though, another thing that I feel like everyone's just canceling their mortgage, and like they may have had other outs.
Right.
And I feel like it might be even a selling point if you can transfer your mortgage, to somebody at a lower rate. Maybe that somebody will want to buy your home.
Yeah, it'll add value. I think when people are buying real estate too, they don't necessarily, in most cases, people don't necessarily anticipate having to sell in the next 2, 3, 4 years, right? Like oftentimes it'll be like, so what's your strategy in the next few years? Oh, I plan on living here for at least the next 5 years. Okay, then a 5-year term might make sense.
Right.
So for sure it's an advantage, but they won't necessarily take that as a consideration. Be like, well, no, I want to live here, so why would I consider having to transfer it in the future?
Right.
But things happen, and
yeah, for sure. Right now, somebody buying a home, is the recommendation to take a shorter term and to wait it out, like to see what happens?
Yeah, so generally speaking, the last 6-7 months, the majority of my clients have been choosing a shorter term fixed rate. Banks and lenders seem to be offering a sweet spot of a 3-year term.
Sweet spot is in best rates?
Yeah. 5-year rates are lower, but there's a big difference between a 1-2-year fixed versus the 3-year fixed. But generally speaking, that's the biggest strategy, the best strategy, I think, right now for most people.
Right.
Just because you'll be able to renew sooner rather than waiting the 5-year period with a lower interest rate.
Right.
As long as the rates come down, right?
Right.
And then it's
Which is the expectation now.
It is the expectation, yeah. And it really just depends on someone's risk tolerance, because I'll still have clients who say, you know what, we prefer to have peace of mind knowing that for at least the next 5 years, this will be our monthly payment, because there is no guarantee, you know, like if inflation really sticks, or if logistics globally get screwed up again and inflation just creeps back up, or for whatever reason, you know, like if it's impossible to guarantee that the rates will for sure come down, right? Like anything can happen.
Besides, I mean, obviously we're not going to have another pandemic anytime soon, but what else could, and I know you're not an economist, but maybe just get your thoughts.
Yeah.
What else could affect inflation and so interest rates as well? Like all this news about, you know, countries ditching the US dollar, for example, right? There's fear in the US that that's going to affect their inflation.
Right.
Is that something people, like the common person, should be worried about?
I think inflation is definitely the biggest kind of variable that they need to be considering. So as long as inflation continues to get closer to the 2% target, rates will eventually come down. But if we start hearing talks about like inflation is stuck at 3%, like that's where the Bank of Canada is ready and willing to increase their overnight rate again.
Yeah. So, okay, interesting. So even if rates are not, if inflation is not coming down, if inflation is coming down, we expect rates to follow.
Yeah.
Okay. But if inflation gets stuck, where it's not coming down anymore, it's not going up, interest rates can still rise to push it down.
Yeah. So,
interesting.
Yeah, the Bank of Canada's overnight rate is really like the biggest, maybe like only tool they have in combating inflation.
Right.
So the Bank of Canada is ready and willing to put us into a recession if they need to get inflation down. So they're willing to overshoot.
That's
they're willing.
Main mandate, right? Is to keep inflation at
2%.
Yeah,
exactly. To control inflation. And they've made it very clear that they are willing to overshoot in the sense of increasing rates a little too much that would cause us to go into to cause us to go into a recession.
Right.
To continue fighting inflation. They would rather overshoot than undershoot.
Fair.
And they've made that very clear.
And it's clear, right, that they've been doing that.
And Powell too in the States has said the exact same thing. Like we are willing to overshoot if we need to.
Right.
And that's why they use the language that's very cautious. You know, like we're pausing for now.
Right.
We're willing to continue increasing if we need to, but they don't want the mentality to be like, oh, they're completely done increasing rates. Let's start buying real estate. And
yeah. Interesting. Yeah. Wow. Super cool. Now, I had a question. I think it was a good one. I think I wrote it down.
I think like a big variable right now is employment numbers too. You know, the job numbers keep coming up.
Yeah, okay, so tell us about that.
Yeah, so unemployment is it's disinflationary, right? It's not disinflationary. It contributes to inflation. When job numbers come in higher than expected, so we're hiring 40,000, I think it was 40,000 new jobs last month, that contributes to inflation because it's combating the possibility of recession, because it's hard to go into recession where we have all-time unemployment.
So when jobs are being created, that's inflationary.
Yeah.
I guess what's the logic there? If jobs are being created, there's more wealth being dispersed and more people are spending.
Yeah, people are able to continue spending.
Yeah. It's expansionary and not recessionary.
Exactly.
So it's inflationary.
Yeah.
Interesting.
So it's tough. And then at the same time, like another fun fact with inflation is that mortgage payments are considered in their inflation calculations. So by increasing rates, mortgage payments go up, but that also contributes to higher inflation. But they're increasing rates to combat inflation.
Wow. So what mortgage? So in the CPI, you mean?
Yeah,
mortgage
exactly.
payments are included. Do they report? Because I know that when they report CPI, they often will report it CPI excluding this or excluding that. But mortgage payments generally are in the CPI.
They are, and in the States, it's calculated
Seems
differently.
kinda
It is. It's. I mean, yeah. I think so. I agree, and
Yeah.
a lot of economists would agree too.
Yeah.
But in the States, they don't consider mortgage payments, but they consider rent as like a massive portion of their calculation. So rent prices. I think
Which is also kind of correlated, I guess, right?
Yeah.
But maybe not so quickly.
Yeah, exactly. There's probably a lag, and then in Canada, we do consider rents, but
Okay.
a much smaller percentage of
Like of the
rents.
CPI is
Exactly.
okay. Sometimes I wonder, like, these are the. It's funny, with SVB, for example. Like, there's people who have made their careers in. Like, I teach an intro to economics class, right? And we learn the basics of supply and demand of bonds, and when rates go up, the price of bonds go down, and the basics. And with what's going on with SVB and how they got into these not bad bonds, but they got into those instruments that, I mean, I think there's nobody that expected rates wouldn't go up.
Right.
So sometimes I wonder if these professionals, like, I know that they took the classes, but I just wonder how they think, like, I have students who are just learning this for the first time and saying, yeah, that doesn't really make sense. Like, why would they buy those bonds?
They thought it was the safe bet, right? Bonds with 2% yields at the time, because I think the biggest factor for them, and for us too in Canada, like a lot of people going with variable rates, was that the Bank of Canada and the Fed too kept stating, like, we're not increasing our rate until 2024. So you're like, okay, well, the Bank of Canada is confirming that they will not be increasing their overnight rate until 2024. Maybe the variable rate's the right move right now, because...
But as always, right, did they use language that was like, we're not gonna, but we will if we have to?
No. It was
straight
like,
up, we're not gonna do it?
And they apologized, like...
Yeah, so but nobody could be really held accountable for that, I guess, right? Because, I mean, that's a bit of a screw up on their end.
It was a massive screw up, a massive screw up. So I think, like, when the Fed and the BOC now, it's going to be hard to take what they say seriously.
Oh, yeah.
But when they tell people, like, we won't be increasing rates until 2024, so like for 2.5, 3 years, but then they increase them 8 times that exact year, it's like, whoa. It's very misleading,
I didn't know that. I guess they're probably going to have to really do something, like you said, all those exceptions, like the 40-year thing. They're probably going to have to do something if people start to get close to defaulting because of what they said. I'm assuming that they'll do something to help.
Yeah.
But again, another example is the in the I think it was Revenue Quebec, or the government of Quebec said we're giving everyone like $600 to fight inflation. But I'm like, well, that just seems inflationary.
Yeah, it is. Absolutely.
So I find it funny.
Yeah.
My whole point is that I find it really funny that these professionals who made their careers in this are doing things that a student who's just learning this for the first time looks at and says, that seems counter to what they're trying to do.
Yeah. I mean, it's tough. It's hard to predict, right?
I'm sure they have.
Economists have it really, really hard. Like, they get asked for all the answers and all the guidance, but it's so hard to know for sure. There's so many variables that we can't predict.
Yeah,
so
that's true.
Everything that they model their kind of predictions on just gets skewed very quickly, very easily.
For sure. I had questions from students that I sometimes when I'm going to meet with people, I collect questions from students. I think I had sent you a few of them. We spoke about the interest rates. The student had asked, do you think rates will keep going up? We spoke about that. How high can it go? I guess there's no real limit. But
technically there's no limit. What I would say is, late 80s, early 90s, they had increased the rates 650 basis points, so 6.5%. And now we've increased them 4.25%, so the Bank of Canada.
Right.
And you'd think that the impact of doing that in the late 80s, early 90s was more significant than the amount they've increased them by recently.
What were rates at back then? Because I think people now got so used to rates being so low that they think that's the normal. But I've heard stories of, like, in the 80s and the 70s when rates were 15% and that was normal.
Yeah. So I don't know that it was normal, but there was definitely, like, economic crisis at the time, which pushed rates up. And what happened then was that the Bank of Canada kind of took their foot off the gas in fighting inflation. They thought it was all good. and inflation stuck and then came back up. So because of that, they had to increase rates twice as high as they would have wanted to.
Right. That's the 650 basis points.
Yeah, exactly. So when they did that, the debt load in Canada was a lot less than what it is today. So by increasing rates by 425 basis points in the last year, the impact is a lot more significant than it was back then.
Right.
So they've been a lot more aggressive in this last year than they were in the late 80s, early 90s. So I don't see the rates ever getting close to that again, because it would be disastrous for the entire economy.
We just have way too much debt right now.
Way too much debt. In 2008, the states offloaded a ton of debt when they went into major recession. As Benjamin Tal from CIBC says, like, Canada was a secondhand smoker to that recession in 2008. Like, we were affected, but we didn't offload basically any debt. And so our debt load is massive compared to the states in relation to our populations. So what he says is, like, the mighty Fed, the Bank of Canada is actually a lot more powerful than the mighty Fed in the States because our debt load is so significant.
So if they bump up rates by, even in 50 basis points, that's significant because of how much debt we have. That's interesting.
And in Canada, like, the impact is a lot quicker also because we have 1, 2, 3, 4, 5 year terms for mortgages. In the States, they lock in the rate for 25, 30 years.
I think that's crazy. I also recently heard about that. I was speaking to somebody from Dallas, and he said, I bought a home, got a 30-year mortgage for like 2% or something. I'm like, oh my God.
Yeah.
We obviously don't have that in Canada. What's the longest term you can get in Canada?
You can get 7 and 10 year terms in residential, but the risk is, like, if you break a 7 or 10 year term after 1 year, that prepayment penalty can be
huge,
disastrous. Yeah.
But can anyone get it?
Yeah. Not every lender offers it, but quite a few of the big banks offer 7 and 10 year terms.
Higher typically?
Right now they're a bit higher. Not much higher, but they're higher.
Yeah, interesting. I wonder if there was, like, if you could see that, I don't know who could see the stat, I guess the banks can. I wonder if there was an increase in those longer terms during COVID when rates were so low.
Maybe. Like, someone who was sure that they wouldn't ever have a reason to break a mortgage, like.
Yeah, I mean, that would be a good time to do that, for sure. Question from a student, I guess they're considering buying or something. Should I buy now, or is the market going to go lower? So I think we spoke about that a little bit, but maybe you can give your thoughts. Like, somebody who wants to buy now or is considering buying now, what do you say?
So I think, like, compared to the last few years, it's a lot more pleasant to be a buyer right now. There's less
versus, let's say, last year or the year before. Okay.
Yeah, there's less competition, so there's less active buyers. Inventory isn't great. The supply is still very low.
Are there still bidding wars going on for properties?
It's coming back, yes. I talk to realtors every day, and in the last few weeks, especially, at least here in Montreal, like, we are starting to see bidding wars on certain types of properties. But no, like, you'll stumble upon properties that have been on the market for a month or two that don't have any offers, and that's when you have a great opportunity to negotiate, to offer under asking.
Right.
So what I recommend to clients when they ask me this question is, if you find a property you love, I think it's worth going for it. Like, do whatever you can to get the property that you love, because you're going to get it at a discount compared to a year or two ago. Yeah. But there's no reason to kind of overbid and to go into a multiple offer situation and just offer 20, 30, 40, 50K over asking right now, because there is opportunity to buy without doing that.
So your recommendation or suggestion is shop around. Like, don't stay out of the market. Just shop around, and if you find something that you like and that you're not really competing for, to go for it. Because you can always renew, right? You can take a 1 or 2 or 3 year term.
Yeah, exactly.
And then renew. And it's not like the higher interest rate today, you're not going to pay $200K more in interest, but you might get a $200,000 discount on the property.
Exactly. So I think there are deals to be had for sure, especially for investors. Yeah. Like, if you go to the Quebec Real Estate Investor Club meetings right now, like, they're going nuts right now. They're loving the current situation, because this is when you find deals. When there's less active buyers is really when you can get really good deals on property.
Interesting. Yeah. Another question from a student. Your 5-year prediction for real estate, I'm guessing value.
Yeah. I mean, this one's tough. We'll see how well this take ages. But I think I think prices are going to continue going up. I don't think we're going to see 20% year over year increases, by no means. Yeah. But I do think that there's still a massive housing shortage in Canada, and I don't see that changing in the next 5 years. I see it getting worse in the next 5 years.
And have you noticed that, and maybe you can tell me how this works, Do real estate values go up? Have you noticed that like further from the city, values are going up more because people are leaving? And is there and do properties downtown go up more or less than like, properties further out?
So during the pandemic, like the outskirts, the prices skyrocketed.
Yeah.
I think that they're still, I don't think they're necessarily coming down, but we should see the city center kind of regain ground in that regard. Like, I don't have the stats in front of me, so I don't want to just spit out any numbers.
Sense. I mean, I live in the North Shore, and I can tell you, like, I don't have the stats either, but I know for sure property values there were going crazy during COVID.
Oh yeah, absolutely.
People buying, I heard stories of like almost like somebody buying, at the very beginning of 2021 and then selling, in the middle of 2022 for 80% more.
Yeah, I've heard those stories too. Like,
which is bonkers.
Yeah, complete bonkers. But yeah, so I
that's over now.
Yeah, I think it's over. But I think they are maintaining the prices. I don't think the prices are going down that much if they have. It really depends on the area. It's always about location in real estate. But we're seeing like properties up north in Laurentians and the townships. We're seeing those prices coming down for sure.
Okay.
Yeah.
Interesting.
But so next 5 years, like I'm still looking to buy real estate. I think anyone who buys today is going to be happy they did in 5 years.
Yeah, I mean, you want to buy now. You don't want to buy when things are great, right? It's like in any investment.
And just like the market kind of switched on a dime where rates, kept going up, and then all of a sudden the market kind of just like cooled down from one day to the other. I think it'll be the same. And we're seeing the market pick up. Like, we're really seeing the market pick up right now in Montreal. But I think that first rate cut from the Bank of Canada, whenever it happens, whether it's like October, November, January, whenever it is, like, I think it's just going to flip a switch and the market's just going to explode again.
Well, as soon as we have one rate cut, right, then the expectation for more rate cuts will everyone's going to be rushing to buy.
So it's a lot more pleasant to be buying right now as opposed to waiting for that first rate cut from the Bank of Canada.
That's a very good point. That's interesting. We spoke about SVB a bit. Canadian banks. So the question is, what do you think about SVB collapsing? What about Canadian banks? Do you think big banks are going to, I guess this is a separate question, do you think big banks are going to fall if it's really bad? Okay, so maybe let's talk about the first one. So Canadian banks, I think we spoke, there's only like 80 banks in Canada, obviously, so it's not as...
And that's like all the financial institutions, like there's probably a dozen banks.
Are there bank failures in Canada? I think in the US, like I found a Wikipedia page where it was like all the bank failures, and I was expecting to see 2 or 3, and there's like hundreds of bank failures in the US.
Recently?
Just in general.
Yeah.
There's bank failures every year. We just don't hear about them. Right. Do we have bank failures in Canada? I haven't heard of any.
No. Like there's way less banks in proportion to the population.
Right.
In Canada, like it's a significant.
Right.
It's like a massive difference. So no, I don't see that happening.
Okay.
I really don't.
And was Canada in any way affected by all this? In any way?
Not really. Like I think even in
maybe people working in startups temporarily.
Yeah.
That's about it.
Yeah. Anyone who had their payroll coming through SVB for a week was kind of like, whoa.
Yeah.
But even in the States, like for sure, SVB failing and the few others is a sign of more and more coming. But I don't think it's a disastrous situation right now. Like I think they changed regulations after 2008 to really protect consumers and to protect and regulate banks.
Yeah, I think you're right. I think consumers will be fine. It's just what's going to happen is the big banks will just get bigger, right? Like I think it's a First Republic that just got scooped up by JP Morgan or something. So I think it'll just be more of that, right?
Yeah, it is a sign of what's to come. Like there is a looming recession in the States, that's for sure. Canada too, but I think more so in the States.
So a bit on that. I think that's what I want to talk about before. So that's what I've been hearing a lot. Like the recession is coming. So I think a lot of people think we're already in the recession. First question, are we? Second question, like, if we aren't, like, what does the recession mean for the everyday person, right? Because despite technically, the stock market is in the pits, and we hear about interest rates being high, everyone's life is pretty much the same.
Yeah.
So what does this really mean for the everyday person if a recession is still coming? Like, what can we expect?
Yeah, it's interesting that I don't think a recession's ever been like predicted for this long and just like talked about.
Yeah.
So it's hard to say. Like, I think that it's very possible that in the States there is like a pretty decent recession. And I think that in Canada, it might be similar to 2008 where we aren't hit as hard, and
Right.
there isn't necessarily as big a crash in the housing market. Not that there necessarily will be in the States this time.
Yeah, I don't think anyone is. I don't think from who I've spoken to is like. No, I don't think people are expecting it to be as bad as 2008.
No.
As far as the housing market.
Yeah, and it's weird, right? Because we're predicting this recession, but unemployment is at an all-time low.
Right.
So it's
That's what I'm saying. Like it doesn't feel like a recession's coming. You know, like sometimes it does, but generally it doesn't.
Right.
So I wonder.
I'm with you. It's just I think it has a lot to do also with like, you know, the Fed and the Bank of Canada. Like, will they continue increasing rates? Because if the longer rates stay this high, you know, the bigger the chance of a significant recession. So I think that's kind of like the main variable.
What would be a trigger for a recession? Like rates stay so high for so long that people start to not be able to pay their things?
I think it's more so like companies start realizing like, wow, like we can't afford to keep this many employees anymore, and then they start laying off. And when we see unemployment start to creep up, that's when the recession could kind of like trigger.
Right, because then that will have a snowball.
Yeah.
People have less money.
Yeah.
They're not spending.
And this is just coming from a mortgage broker who's not by any means.
It makes sense.
economist,
Just economics 101. That makes sense, right? If there's more employment, there's less money floating around.
Yeah.
That's going to fix the inflation problem.
Yeah.
But that typically comes, you know, at the height of an expansionary period, and then recession follows, right? So yeah, I mean, economically,
it makes sense.
That's, you know, what's supposed to happen.
Okay, cool.
So I guess we'll see.
Yeah.
That's interesting. Okay, so maybe we'll pivot now. We'll talk about, again, this career path that you chose, because
Sure.
you know, a lot of my students are in finance,
Okay.
accounting, JMSB students, right? So in various business fields. You know, if they're interested in the real estate market or in this career, like what are the things that they can do, or how can they learn more about this? Because, you know, everyone hears about, like you said, 20,000 real estate brokers.
Yeah.
I know one mortgage broker, and it's you.
Yeah.
Okay. Maybe I know another one. I don't know. But a student who's looking to go down that path, what are some of the things that you would tell them? You know, now having been in it for 3.5 years, but you didn't join that out of the gate, right? So what are some things you can say to students who are looking at different career options? Like, what can you say about this particular one?
Yeah. So first of all, like I love what I do. I love the field. I love the challenge. But as a mortgage broker, you are self-employed, right? So like a real estate broker, you do work maybe under a banner, but you're completely self-employed. So I think, and you're paid solely commission. Like there's no base salary.
Right.
So if
it's like you're an entrepreneur. It's your own business.
It's your own business,
Yeah.
right? So you're growing your own business. You know, as you grow, you hire your own staff,
Right.
and you grow your own team.
Right.
So you definitely need that motivation and that drive to kind of grow your own business. And it's definitely not for everyone. You know, like there's probably as many mortgage brokers who get licensed who leave in their first year as who stay.
Really?
Yeah, just because you have to go get that business, and you're competing against other mortgage brokers, but you're also competing against the big banks, you know? So it's a customer service based sales business. So it is sales, but your customer service is what really makes the difference between you and another mortgage broker, because we have access to the same banks, to the same products.
Right.
So it's the knowledge you're able to, you know, give to the clients, but also the customer service that you're offering.
Yeah.
So you have to be ready to compete and to kind of go above and beyond for your clients to ensure that you can continue growing, continue getting referrals. So it's a very competitive business.
Would you recommend that somebody who's interested start at a bank?
I think it's a good place to kind of learn and understand how the processes work. I don't think it's necessarily the best strategy to stay with one bank for too long. I think another strategy can be to get licensed as a mortgage broker and maybe work for a successful mortgage broker, because we have teams.
Sure.
And that's a really good way of learning, is to work
under one, and what would that mean for somebody? So right now you work for Orbis.
Yeah.
You're under the Orbis banner.
Correct.
Right. Are you part of the team?
No. So
Solo,
yeah.
Okay. Are you planning to, do you foresee hiring people under
Yeah,
you?
so I have a full-time assistant.
Okay.
And yeah, the plan is to continue growing.
Is that
hire.
assistant a one day, like they hope to be mortgage brokers, or are they just?
No, administrative assistant, yeah.
Interesting. Okay, so not them. Let's say a student who is interested in this. and gets a job working for you one day in the future, what would their role be, and how would they be learning from you? Would they be helping you? Would they be assigned to their own clients?
Yeah, so there's two kind of routes, and they could start as an administrative role for the first 6 months to a year to kind of really understand how the processes work. But then I think that my next hire will probably be a mortgage broker. So
would they have to be licensed already?
they would have to be licensed to talk about mortgage products to the clients. Yeah.
Okay.
But as a mortgage broker, they're allowed to talk, first of all, to the client directly about the different products, but they're also allowed to submit an application to a lender. So unless you're licensed, you're not allowed to submit someone's file to a lender.
And you can't speak about it either?
You're not allowed to talk about the mortgage product. So you can ask for certain documents and talk about the process, but you're not allowed to give any advice or discuss different rates.
So somebody who wants to get a job, somebody coming out of school wants to get a job working for another mortgage broker should start by getting licensed.
Yeah.
Otherwise they can't really.
Yeah. And they could start in an administrative role while they do their license.
Right. That's a good one.
Yeah. And I believe it's like a 6-month process with the AMF to do the course and then to eventually do your exam. And then I think there's a 3-month probationary period.
Okay.
So probably like an 8-month period from A to Z to be fully licensed.
Yeah.
But yeah, I think working for another mortgage broker is the best way to go about it. I have colleagues who've worked for really successful brokers, and they are really well versed coming out of the gates when they go out on their own. And
how do you get clients? I mean, you're doing Instagram, which I think is really cool.
Yeah.
You know?
So the classic is a client saying, I want to buy a property. So they think of calling a real estate broker. And then the real estate broker, like I mentioned earlier, will say, well, are you pre-approved for a mortgage? No. Okay, go see Matt. So real estate brokers will often, I work with a lot of real estate brokers, but financial planners too.
Yeah.
Accountants.
Yeah.
Notaries.
Yeah.
You know, so, and then it's a lot of word of mouth. So I think it's one of the only remaining industries that still works very well on word of mouth. You know, like I have colleagues who are very successful who don't do any marketing, but all of their business is word of mouth. Yeah.
Hold that thought for a second. Okay. So I guess the last thing I want to get into is, unrelated to the specifics, real estate, interest rates, your specific career, but more so, as you mentioned, you're an entrepreneur. You are 100% of your income is based on your performance, right?
Right.
So, what are some of the things that motivate you, that drive you, that really that motivated you, let's say, to get into something that is risky,
right,
and keep you going every day?
What motivated me? I think, so growing up, like I'd ask my dad, like, why did you go into the business you went into, which he's a serial entrepreneur, pure salesperson, and he now runs like a pretty massive company that they do scrap metal, right? And that's what he did before the fireplace business also. So I would ask him, like, why did you go into the scrap metal business? And he's like, because I like making money. Like, it's not about the scrap metal business. It's more about like just making money. And like, I really love doing mortgages, but it's like, for me, it's about, making good income. And I think that when you're an entrepreneur, when you're self-employed, there is no limit to how much you can make, right? So as opposed to being a salaried employee where you could get bonuses and raises every year, when you're self-employed and when you're in the mortgage business, there is no ceiling. You can grow a mortgage business to make a really significant amount of money. So you're not limited by the employer. So that's what I really, really like about it. I like that I'm in control and that I can keep pushing and growing my business in a way that allows me to make more and more and more money if I wanted to.
Interesting.
Yeah.
And we'll take a step back. I just thought of one more question that has to do with your specific career. I understand how real estate agents make their money.
Yeah.
I sell a property, I get 5%, I give 3% to the seller or buyer, whatever. As a mortgage broker, is it similar? Is it a percentage of the loan?
Correct, yeah. So it might be in between 0.4% and 1.1 or 1.2% of the mortgage amount that you'll get as a commission, gross.
And then I guess like a real estate agent, the banner gets a certain amount and...
Yeah, exactly.
Interesting.
Yeah, exactly. You'll pay the banner. There's other services that you can have access to that you would give cuts for, and then you pay your staff too, and so you'll get a percentage of the mortgage amount.
Interesting.
Yeah.
Cool. Yeah, that's what I thought it was, but I just wanted to ask. Again, I have a lot of students who are that's the first question they're gonna ask, right?
It's a great industry, but like I said, like you have to be ready and willing to be self-employed and to take the risk of like having no income when you start. Like there is no base salary.
Yeah.
Yeah.
Interesting.
Which is what I like about it too. You know,
Yeah.
like you don't have a choice. Like it's like you don't have a choice but to go get business. Like you have to if you want to make money.
Are you still flipping, or was it just that one flip that you did?
So now we have more of a renovate, rent out, and hold strategy.
Okay.
But yeah, we're still investing in real estate and still looking to buy more.
Interesting.
Yeah.
Very cool.
Yeah.
Yeah, I think those were all the questions that I had. I mean, this was really, this is why I do this, right? It's like, other than making content, which I think my students are really going to appreciate, there's a lot of questions just that I have, and I really enjoyed this. So that's pretty much it.
Cool. Well, thanks for having me. Like,
yeah.
if ever your students do want to reach out and if they want to just, ask me questions or talk about the potential of them going into mortgages or for whatever reason, like I'm always happy to chat.
Yeah, for sure. I'll link you. on Instagram and yeah, if anyone has any questions about mortgages, Matthew's definitely the person to ask and not me. So I appreciate that. The students will like that too.
Right on. Thanks for having me.
Yeah, man, that was fun. That was cool.